Right, boys, we're back. Episode 2. So, this episode, we're doing liquidity levels and the actual 2022 setup itself. So, let's jump right into liquidity and liquidity levels. Okay, so very quick introduction to liquidity. Obviously, I'm kind of assuming a lot of people know this, but if you don't know what liquidity is, it's essentially as the markets, imagine the market's going higher, we make a high. We make a low, we make a high. We make a low, we make a high. These lows in price look more like with the candles. We have, so a swing high is this pattern here. So we have higher this candle comes higher than this previous candle. So this high sticks out above this one. And then this candle doesn't break this middle candle, the high of that candle. So this is a swing high here. So above that high is liquidity on every time frame, every chart. So if we come back to the incredible drawing, we've got buy side liquidity up this above this high. So we label this as, let's do it in black, because blue on blue just doesn't really pop out. We label this as buy side liquidity instead of buy side is sell side liquidity, because the sell stops resting under this low here. That is essentially liquidity. Above highs and below lows is where liquidity is. But for this model, we don't care about these individual random highs and lows in the market. What I try and look out for is what's called, I refer to it as time-specific liquidity levels. So within a window of time, we have time-specific liquidity levels. So the ones that I look out for, and I'll mark these every day on a 15-minute, well, it doesn't really matter what time frame you mark out on. I'll just normally do it on a 15-minute chart, because that's like the easy go-to time frame for me whenever I'm framing like a daily sort of session, like what I'm looking at for the daily range, and then I can see my liquidity levels nice and easily. And these liquidity levels that I look out for is I will mark the highest high and the lowest low in the London session for liquidity. So that's 2 a.m. to 5 a.m. I'll mark out the highest high and the lowest low in that time frame. And the previous PM session liquidity. So the previous day, so say we're on Wednesday's trade-in, I will look back at Tuesday's trade-in from 1:30 p.m. until 4 p.m. and I'll mark out the high and low of that session as well. And these are the levels that I'm looking for the price to come up to or down to, sweep them. So let's say I have a bullish daily bias. I will look for price to come sweep the London session low if I'm bullish, because I want to see it sweep sell side liquidity and then come up to the upside for the daily range. Or I will look at the previous PM sessions low for that same thing to occur. So these are the levels I'm looking at for as far as time-specific liquidity. Obviously, we have things like previous days low as well. If I'm looking for a bullish move, previous days low, you could also say that's a time-specific liquidity level. Previous weeks low, previous months low, really, but obviously they don't happen as often, but they're definitely levels you can look at for these this setup for sure. So just to show you what it would look like if I'm marking this up on a chart, we would have London sessions low here. So by the way, all of this time element, the time element that I'm referring to is all New York time. So if you go in TradingView and you select UTC -5 is what it is right now. Obviously that can change when daylight saving shift. But if you just go into your clock and put New York, you'll be marking up the same time-specific things that I'm marking up, just as a easy thing that ICT does, which actually makes it very easy for you to not mess up. So we have London session low, so I will always label that London low, so I know which time-specific level it is. And then up here, you can see 2 a.m. starts there, so this would be London sessions high. So London high. Also, we have another liquidity, not so much time specific, but definitely important, is we have relative equal highs. So you can see this high here. If I zoom in, you can see that this high here actually is lower than this high. So this isn't, we ignore this. When we see highs like this, where we have a high, price comes down, comes back up and just goes underneath it, they're relative equal highs, or if it was flipped, relative equal lows. they're also very significant liquidity levels that I will always mark out if I see them. Typically, I'm looking for them on like a 5-15 minute, but I will go down as low as a 1 minute, and I will mark out relative equal highs and lows if I see them. And while, just so you know how I mark them up, I'll have my time specific levels normally on the like 2 thickness on the line. If I see relative equal highs, if they're obviously relative equal highs that are also a time specific liquidity level, they'll still be in like a thicker line. But if they're not time specific, if it's just like a random liquidity level, I will just put in a lower thickness, so a 1, and then I'll just type on it relative highs or equal highs. And then I know obviously that's what that level is. So again, I use relative highs more as a target than a place to look for an entry, because unless we have relative highs on both sides, then you can do a really nice setup where you just wait for one of the relative equal highs to get swept, and then if that high or low that's been swept, the relative highs or lows, is in line with your daily bias. So let's say we make relative highs, relative lows during London or the previous PM session for the day. Then going into the morning session, if I see relative highs and relative lows and I'm bullish, I will want to see the highs get swept, the lows get swept if I'm bullish, and then run for the highs and go beyond it. Or alternatively, it is still okay if you want to see the relative highs get swept. If you're bullish, get the relative highs to get swept, and then it comes down and sweeps the relative lows, and then reverses and goes up for the rest of the day. They're like not often that happens, to be honest, or for me at least. But they are definitely setups you can take as well. So we've gone over previous PM session. I'll just show you that on the chart now, so that easy. If I was looking here for Monday's trading, for Tuesday's trading, looking at Monday's liquidity, I would mark this level out there. And buy side, I would change that to previous PM high. And then I would simply look at where 130 was, which is here. And then obviously we have this low here. And then at 4, we have this low. So this would be the previous PM session low. Obviously, this isn't important because it got swept straight away. So we don't drag them through. If you go very deep into ICT theory, I guess, he will talk about dragging specific liquidity levels and dragging them through price, because the algorithm will refer back to those liquidity levels. And then you can look for things like that. But I tend to just try and keep it as simple as it can. So that would be liquidity level I would look for going into Tuesday's trading. Obviously, I would have them relative highs marked out as well, but I would have had previous PM session high, London high, got swept, obviously, just after London session got swept. And then obviously it ran for London session low before the market opened. So this is a pretty difficult day, obviously. When all liquidity levels get swept, I will look further back in price and look at maybe the day before. So you could, if say all this has been used, which it was on this day, you could look at Monday's PM session highs and lows, or you could even look back at Monday's AM session lows, or this is Tuesday, yeah. So Monday's AM session lows. So that would be 9:30 till 11 is the times I'd look for there for them liquidity levels. And then again, previous day's lows, previous week's lows, all them ones, all very nice, important liquidity levels. I will write all this down so you can just screenshot it instead of having to listen to me waffle. But we will get into now what the actual setup looks like. Okay, so as far as the actual setup, this is what it looks like. So we have a labeled buy-side liquidity levels. That can be any of those liquidity levels I've just gone over. And then what we're looking for, obviously this is if you have a bearish daily bias, we're looking for price to come up to this liquidity level. And then once it's come up to this level, my eyes instantly will look back on a 5, 4, 3, 2, and 1 minute chart. You can very easily just type the number in on TradingView. So you can just type 4, 3, 2, 1. You can do it like that, or you can just put them all at the top here. I actually don't really tend to use the 4 minute. I will check it every now and then, but I don't even have it on my favorites because I use it that like that little. But 5, 3, 2, 1, I will constantly be flicking through. And when you're looking at these different time frames, what you're looking at is for a swing low to be broken with displacement. Now, displacement is just when speed enters the marketplace. So you see a real aggressive move, and you'll see it when price prints, and it prints really fast, and it will break that low with displacement, with speed. And in this displacement leg, we refer to that as the displacement leg, you want to be looking for your fair value gap. So if you don't know what a fair value gap is, a fair value gap is essentially a 3-candle pattern that you'll see on these charts, where the first candle will print, the second candle will print a further leg, and then the third candle will print a further leg on top of that. And the middle candle won't be overlapped by the first and second, or the first and third candle. So the first and third candle aren't gonna meet at the same level between the middle candle. So if I just point it out, you can see it's a bit of a weird thing to explain, so you might not have understood, but if I point them out here, that would be a fair value gap. I feel like I butchered that explanation, but you can see them very clearly here. So if you see this first candle, which I'm hovering over now, that candle comes down, stops here. The lowest point it goes is there. So that is the high of this bearish fair value gap. When we have the middle candle, so the second candle of the pattern, that trades down, closes down here. Third candle opens, trades up, leaves all this portion imbalanced. So this has just got sell side delivery. So leaves this, moves away, and actually obviously creates another fair value gap here, which I'll label. So that would also be a fair value gap. So yeah, then this one trades down, opens, this one comes up, down, closes. And then when that closes, this is a fair value gap, this is a fair value gap, and if you were paying attention, this is also a fair value gap. So they're everywhere, but you want to be looking for specific ones for this exact model. Okay, so you know what the fair value gap is now. So we're looking for that in this displacement leg after this low has been broken. So when this low is broken, 5, 4, 3, 2, 1, looking for this fair value gap. Whatever time frame you see it on first, that's the one that you're going to work with. So if you see it on a 5-minute chart before it even prints on a 1-minute chart, because sometimes as the 1 minute comes down, it might come down and do a lot very back and forth and not print any fair value gaps. But if you go on a higher time frame like the 5, 3-minute charts, then it will still print the fair value gap, because even though the 1 minute has been going back and forth, but it has been going down on a higher time frame, that back and forth action will just be included in those bigger time frame candles. So that's why it's worth your time checking each of the time frames so you don't miss the entry, because when you are so focused on one time frame and then you're like, oh, this didn't even give me an entry, and then you go back and look at it later and see that if you were just looking at a different time frame, which one of the time frames you should have been looking at, and then you miss that entry, you'll just be kicking yourself in the head, especially if the trade pans out to will have made you millions and millions and millions of pounds, because you know that's how day trading works. You just place one trade and make millions. But yeah, that's the actual trade framework, I guess. Like, that's what the actual model will look like. I will go into my journal right now and just show you a trade, because I can't be bothered to find one. I will go into a journal entry of one of my trades and show you what that entry looks like in the actual chart, not just using drawings. Okay, so this is a journal entry from Monday the 9th of December 2024. As you can see, we had these equal lows on an hourly chart, which were my draw for this day on a higher time frame. So that gave me my bias as a bearish daily bias. If I just go on to the entry, this is the 15-minute chart. So obviously we have this 15-minute low. I'm not sure what time split. I'm trying to eyeball. It looks like it's the previous day's AM session low, just eyeballing it. And then we came up into, if I go onto the 1-minute chart, we came up into not a liquidity level, but a fair value gap, or a new week opening gap, actually, I think is what it is. I'll go into them in a later episode, don't worry. Not holding out on you boys, but all I want you to focus on here is the entry. So as you can see, high, low, displacement, fair value gap. Price comes up into the fair value gap. The bodies perfectly respected it, and then we tapered off and yeah, the rest is history on that one. But yeah, this is what I want to focus on here. This is what a 2022 model, when you picture it in your head, this is what you picture in. You picture in higher prices, higher prices, higher prices. Low comes into a point of interest slash what, or you at the moment just focus on liquidity levels. Comes into a liquidity level, boom, displacement, fair value gap. Price comes up into the fair value gap, and that's your entry. And then you're gonna go short right at the high, the high of this candle for shorts. So if you think about the 3 candle pattern for a short, that third candle is going to be the lowest candle, obviously, in the fair value gap, because you're going to be entering on a bearish fair value gap for a short. The high of that third candle, that is where you place your limit order, your sell limit order. If it was a buy, you would have the third candle be the highest, most likely, and you're placing your buy limit at the low of that third candle. So that is, as far as entries, is all you really need. But we will get into the next episode, where we will go over... What are we going over? Let me check my notes. Okay, so in the next episode, we'll get into top-down analysis, which basically just means breaking a trade down from daily/weekly down to the 4 hour, 1 hour, 15-minute, 5, 4, 3, 2, 1. That's top-down analysis. So we'll go over that in the next episode. And we'll also go over targets, as far as when I'm in a trade, where is my target and where is my stop loss. They're two important things probably once you're in a trade. You want to know where is my stop loss and where is my take profit, or take profits, because we take partials for this model. But yeah, we will get all that into all of that in the next episode. So feel free to like and subscribe if you found this insightful or useful at all, and I'll catch you boys in the next episode.